So, you want to get into trading? You see those charts with all the squiggly lines going up and down, and it looks like a complete mess, right? Well, what if I told you those lines are actually telling a story? They're speaking a language, and if you can learn to understand it, you can get a massive edge. That's where chart patterns come in. These aren't just random shapes, they are visual representations of supply and demand, of investor psychology playing out in real time. Mastering these patterns is like having a roadmap for the market. It's one of the core pillars of technical analysis, and honestly, it's a skill that can literally make or break your trading career. It's not about predicting the future with 100% certainty, nothing can do that, but it's about putting the odds significantly in your favor. In today's video, we are going to do a deep dive into the most powerful and common chart patterns that you're going to see over and over again. We're not just going to glance over them either, we're going to break down exactly what they are, how they form, and most importantly, how to trade them for a potential profit. We'll cover the continuation patterns that suggest a trend is just taking a breather, the reversal patterns that signal a major shift is coming, and even the tricky bilateral patterns that could go either way. By the end of this, you'll be able to look at a chart and see opportunities where before you just saw chaos. I'm going to walk you through everything step by step. We'll look at flag patterns, pennants, triangles of all kinds, ascending, descending, and symmetrical. We'll get into the classic head and shoulders, double and triple tops and bottoms, and even the more subtle rounding patterns. I want to make sure you have a complete toolkit. And stick around until the end, because we're going to go through real-life chart examples for every single one of these patterns, so you can see exactly how they play out in the wild. So, if you're ready to level up your trading game, make sure to smash that like button for the YouTube algorithm, and let's get right into it. Alright, let's kick things off with one of the most reliable patterns you'll see, the flag pattern. Think of this as the market taking a quick coffee break. It's a continuation pattern, which means it signals that the prior, very strong trend is likely to continue after a brief pause. So, if a stock has been shooting up like a rocket, you might see a bull flag form. This pattern is your signal that, hey, the buyers are just catching their breath before they push the price even higher. It's a moment of consolidation before the next leg up. The structure is pretty easy to spot once you know what to look for. First, you need what's called the flagpole. This is a sharp, almost vertical price move, either up or down. It's the initial explosive move that gets everyone's attention. After the flagpole, the price action starts to drift sideways or slightly against the main trend, forming a small rectangular shape that looks like a flag. This rectangular part is defined by two parallel trend lines. In a bull flag, the flagpole is an up move, and the flag itself will be a gentle downward slope. Conversely, you have the bear flag. It's the exact opposite scenario. The flagpole is a sharp, aggressive drop in price. Then the stock consolidates, forming a flag that drifts slightly upwards, channeled between two parallel lines. This is the market pausing for a moment before the sellers regain control and push the price down even further. It's a sign that the downtrend is still very much intact, and the small rally is likely just a temporary interruption before the next significant decline. Spotting this can save you from buying into what looks like a recovery but is actually a trap. So, how do you actually trade this? It's pretty straightforward. For a bull flag, you're looking to enter a long position when the price breaks decisively above the upper trend line of the flag. Don't jump the gun, wait for a clear breakout with some volume to confirm it. For a bear flag, you'd look to enter a short position when the price breaks below the lower trend line of the flag. The breakout is your trigger, your confirmation that the brief consolidation period is over and the original trend is resuming. Now for the best part, calculating your target. This is what makes the pattern so powerful. The general rule is to measure the height of the flagpole, from the start of the move to the highest point of the flag. Then, you project that same distance from the point of the breakout. So if the flagpole was a $10 move up, you'd add $10 to the breakout price to get your profit target. This gives you a clear, objective target for your trade, taking a lot of the guesswork out of the equation. It's a simple, yet incredibly effective way to plan your exit. Next up, we have the pennant pattern. This one is very similar to the flag pattern we just discussed. In fact, think of it as the flag's more compact, triangular cousin. Just like the flag, the pennant is a continuation pattern. It signals a brief pause in a strong trend before the trend continues in its original direction. The main difference lies in the shape of the consolidation phase. While a flag has parallel trend lanes, a pennant is formed by converging trend lanes, giving it that small triangular or pennant-like shape. The formation starts exactly the same way as a flag with a flagpole. You need that initial strong, near-vertical price move. This is non-negotiable. Without a flagpole, you don't have a pennant, you just have a small triangle. After this explosive move, the price action begins to consolidate. But instead of moving between parallel lines, the highs get lower and the lows get higher, causing the trend lanes to converge. This tightening price action shows that volatility is decreasing as the market prepares for its next big move. Just like flags, pennants come in two flavors, bullish and bearish. A bull pennant forms after a strong uptrend, the flagpole. The price then consolidates within converging trend lanes, coiling up like a spring. This indicates that despite the pause, the buyers are still very much in control, and they're just accumulating more positions before pushing the price higher. It's a sign of strength, showing the market is absorbing the recent gains healthily before the next upward thrust. It's a high probability setup for a continued move to the upside. A bear pennant, as you can probably guess, is the mirror image. It occurs after a sharp downtrend, the flagpole. The price then bounces a little, but the bounces are weak, and the range gets tighter and tighter between two converging trend lines. This is the market taking a very short breather before the sellers come back in full force to continue driving the price down. The converging lines show indecision, but the preceding downtrend gives it a strong bearish bias. It's a warning sign that the pain isn't over yet for this particular stock. Trading a pennant is almost identical to trading a flag. For a bull pennant, your entry signal is a decisive breakout above the upper descending trend line. You want to see the price close firmly above that line, preferably with an increase in trading volume, to confirm the breakout. For a bear pennant, you're looking for a breakdown below the lower, ascending trend line. The profit target calculation is also the same. You measure the height of the flagpole and project that distance from the breakout point. It's a simple, repeatable strategy that works time and time again. Now let's talk about a family of patterns you'll see all the time. Triangles. We'll start with the ascending and descending triangles. These are fantastic patterns because they paint a very clear picture of the battle happening between buyers and sellers. An ascending triangle is generally considered a bullish pattern. Its structure is defined by a horizontal resistance line at the top and an ascending trend line forming higher lows at the bottom. Think about what this means psychologically. What the ascending triangle shows is that there's a certain price level where sellers keep stepping in, creating a flat top or a ceiling. However, the buyers are becoming more and more aggressive. Each time the price dips, they buy it up at a higher price than before, creating the series of higher lows. This tells you that the buying pressure is building up. Eventually, the theory goes, the buyers will become so strong that they will overwhelm the sellers and break through that horizontal resistance level, leading to a significant upward move. The trading strategy here is to wait for that breakout. You don't want to buy while the price is still inside the triangle because there's always a chance it could fail and break down. The high probability trade is to enter a long position once the price closes decisively above the horizontal resistance line. A surge in volume on the breakout is a great confirmation signal. It shows that there's real conviction behind the move and it's not just a fake out. Patience is key. Let the pattern complete itself before you act. On the flip side, we have the descending triangle, which is the bearish counterpart. This pattern is characterized by a horizontal support line at the bottom and a descending trend line forming lower highs at the top. It's the mirror image of the ascending triangle. Here there's a specific price level where buyers keep stepping in to support the price, creating a flat floor. However, the sellers are getting more aggressive. Each time the price rallies, they sell it at a lower price than before, creating the series of lower highs. This structure tells you that selling pressure is building. The sellers are slowly but surely gaining control, pushing the price down against that support level. Eventually, the expectation is that the sellers will overwhelm the buyers, and the price will break down through that horizontal support. To trade this, you'd look to enter a short position on a decisive break and close below the horizontal support line. For both triangles, the target is calculated by measuring the widest part of the triangle, the height at the beginning, and projecting that distance from the breakout point. Let's move on to the rectangle pattern, which is sometimes called a trading range or a consolidation box. This pattern is pretty easy to spot because, well, it looks like a rectangle. It's formed when the price of a stock moves between two horizontal lines of support and resistance. The price bounces back and forth between this ceiling and floor, creating a clear channel. This indicates a period of indecision in the market, where neither the buyers nor the sellers have enough strength to push the price into a new trend. The rectangle can act as either a continuation or a reversal pattern, but it's more commonly seen as a continuation pattern. For example, if a stock is in a strong uptrend, and then enters into a rectangle pattern, it's often referred to as a bullish rectangle. This suggests that the market is just taking a pause, consolidating its gains, and accumulating energy before continuing the upward trend. The buyers and sellers are in a temporary state of equilibrium before the buyers who were dominant before are likely to regain control. Conversely, if a downtrend is followed by a rectangle pattern, it's known as a bearish rectangle. This signals a pause in the selling pressure. The stock bounces around in a defined range as the market catches its breath. However, the prevailing downtrend suggests that the sellers are likely to win this battle of attrition and eventually push the price below the support level to continue the move lower. The rectangle itself is a period of sideways drift before the prior trend reasserts itself with force. Trading the rectangle offers two main strategies. The first and more conservative approach is to wait for a breakout. For a bullish rectangle, you would buy when the price breaks and closes above the top resistance line of the box. For a bearish rectangle, you would sell or short when the price breaks and closes below the bottom support line. This is the trend-following approach, betting that the prior trend will continue as expected. It's generally the safer way to trade this particular pattern. The second strategy is for more aggressive range-bound traders. You can actually trade within the box itself. This involves buying near the support level at the bottom of the rectangle and selling near the resistance level at the top. This can be profitable, but it's also riskier because you're trading against the short-term momentum within the range, and you're always at risk of a breakout happening against your position. The price target for a breakout is calculated by measuring the height of the rectangle and projecting that distance from the breakout point. Now we're getting into one of the most famous and, in my opinion, one of the most reliable reversal patterns in all of technical analysis, the head and shoulders pattern. When you see this one form correctly, you need to pay very close attention because it often signals the end of an uptrend and the beginning of a new downtrend. It's a classic top formation. The name comes from its appearance, which literally looks like a person's head with two shoulders on either side. It's a very visual representation of a shift in market sentiment. The pattern consists of three peaks. The first peak is the left shoulder. After this peak, the price pulls back. Then the price rallies again to an even higher peak, which forms the head. Following the head, there's another pullback. Finally, the price rallies one last time, but this rally fails to reach the height of the head, forming a lower peak, the right shoulder. This failure to make a new high is a major sign of weakness. It shows that the buyers are losing their momentum and are no longer in control. The key to this entire pattern is the neckline. The neckline is a trend line drawn connecting the low points of the two pullbacks, the one after the left shoulder and the one after the head. This neckline acts as a critical level of support. The head and shoulders pattern is not considered complete, and the bearish signal is not confirmed until the price breaks down and closes below this neckline. A breakdown below the neckline is the trigger, the sign that the sellers have officially taken over from the buyers. Then you have the inverse head and shoulders, which is the bullish version of this pattern and signals a potential market bottom. It's the exact mirror image. It forms after a downtrend and consists of three troughs, a left shoulder, a lower trough for the head, and then a higher trough for the right shoulder. The neckline is drawn by connecting the high points of the two rallies within the pattern. A breakout above this neckline signals that the downtrend is likely over and a new uptrend is beginning. The trading strategy is clear-cut. For a standard head and shoulders, you enter a short position on a decisive break below the neckline. For an inverse head and shoulders, you enter a long position on a break above the neckline. The profit target is also very well defined. You measure the vertical distance from the top of the head down to the neckline. Then you project that same distance downwards from the point where the price broke the neckline for a short trade or upwards for a long trade. It's a powerful tool for catching major trend reversals. Let's discuss two more incredibly common and powerful reversal patterns, the double top and the double bottom. These are a little simpler than the head and shoulders, but work on a very similar principle of failing to make new highs or new lows. The double top is a bearish reversal pattern that looks like the letter M. It forms at the end of an uptrend and signals that the upward momentum is fading and a potential reversal to the downside is on the horizon. It's a clear sign of exhaustion from the buyers. The pattern begins when an uptrend hits a resistance level and makes a peak. After this first peak, the price pulls back to a support level, which we call the confirmation line or neckline. Then the buyers try to push the price up again, but they fail to break above the previous peak. The price rallies to approximately the same level as the first peak and is rejected again. This failure to create a higher high is a significant red flag. It shows that the buying pressure is not strong enough to continue the trend. The bearish signal is confirmed when the price breaks down below the support level of that pullback between the two peaks. This breakdown shows that the sellers have now taken control, and the support that held up the price previously has now failed. To trade this, you would look to enter a short position once the price closes firmly below that confirmation line. Rushing in before the confirmation is risky, as the price could simply be consolidating before another attempt to break higher. Waiting for the break is crucial. The double bottom is the bullish counterpart and looks like the letter W. It's a bullish reversal pattern that forms after a downtrend. It signals that the selling pressure is easing and a potential reversal to the upside is coming. The price falls to a low, then rallies, then falls back to test that same low again. The sellers are unable to push the price to a new lower low, which indicates that they are losing their power. This creates two distinct troughs at roughly the same price level. The bullish signal is confirmed when the price breaks out above the resistance level of the rally that occurred between the two bottoms. This breakout is your trigger to go long. It confirms that the buyers have absorbed all the selling pressure at that support level and are now strong enough to push the price higher, starting a new uptrend. The profit target for both the double top and double bottom is calculated by measuring the distance from the peaks or troughs to the confirmation line and projecting that distance from the breakout or breakdown point. Now, if a double top or bottom is a strong signal, what do you think a triple top or triple bottom signifies? These patterns are even more powerful and reliable, although they occur less frequently. A triple top is a bearish reversal pattern that forms when the price tests a resistance level 3 separate times and fails to break through each time. Think of it as the market knocking on a door 3 times and getting rejected every single time. It's an extremely strong indication that the buyers are exhausted. The structure is similar to the double top, but with an extra peak. The price rallies to a high, pulls back, rallies to that same high again, pulls back, and then makes one final attempt to break the resistance level, only to fail for a third time. These 3 peaks should be roughly at the same price level. The 2 pullbacks in between the peaks form 2 support lows. A confirmation line can be drawn connecting these 2 lows, similar to the neckline in other patterns. This line is the key. The pattern screams that there is a massive wall of sellers at that resistance price. No matter how hard the buyers try, they cannot overcome it. The repeated failure to break higher erodes the confidence of the buyers and emboldens the sellers. The definitive sell signal comes when the price breaks down and closes below the confirmation line connecting the 2 lows. This breakdown confirms that support has given way and the sellers are now in complete control, likely leading to a significant and sustained move down. On the other side, we have the triple bottom, which is a very strong, bullish reversal pattern. It forms after a prolonged downtrend and looks like a W with an extra dip. The price hits a support level 3 times and bounces back up each time. The sellers try repeatedly to push the price to new lows, but they fail on 3 separate occasions. This shows that there is a huge amount of buying interest at that support level, creating a solid floor for the price. The confirmation of the triple bottom comes when the price breaks out above the resistance line connecting the 2 peaks of the rallies between the 3 bottoms. This breakout signals that the sellers have finally capitulated and the buyers have seized control. It's a very strong signal that the long-term downtrend is over and a new uptrend is beginning. For both triple top and bottom patterns, the profit target is calculated by measuring the height from the peaks or troughs to the confirmation line and projecting that distance from the breakout point. Let's talk about a couple of patterns that are a bit more subtle and take longer to form: the rounding bottom and the rounding top. These are also major reversal patterns, but unlike the sharp V-shaped reversals of a double bottom or the distinct peaks of a head and shoulders, These patterns represent a much more gradual and slow shift in market sentiment. The rounding bottom, also known as a saucer bottom, is a bullish reversal pattern that signals the end of a downtrend. The pattern looks exactly like its name suggests, a gentle, rounded curve at the bottom of a price chart, like the bottom of a bowl or a saucer. It begins with a downtrend that gradually loses its momentum. The price decline slows, then moves sideways for an extended period, and then slowly begins to curve upwards, starting a new uptrend. This gradual curve shows a slow transition of control from the sellers to the buyers. There's no single dramatic event, just a steady, grinding shift in psychology. Volume often plays a key role in confirming a rounding bottom. Typically, trading volume will be high at the beginning of the decline, then it will decrease as the price moves sideways at the bottom of the curve, and finally, it will increase significantly as the price starts to rally and breaks out. The breakout point is usually identified by the resistance level, formed by the high point at the beginning of the pattern's decline. A break above this level confirms the reversal. The rounding top, or saucer top, is the bearish counterpart. It's a reversal pattern that signals the end of an uptrend and the beginning of a new downtrend. It looks like an inverted bowl or saucer. The price action shows an uptrend that gradually loses steam, flattens out at the top, and then slowly begins to roll over and head downwards. This represents a very gradual and methodical shift in control from the buyers to the sellers. It's a sign of a market that is slowly running out of energy. Trading these patterns requires a lot of patience because they can take a very long time to fully develop, weeks, months, or even longer on a daily chart. For a rounding bottom, the buy signal is the breakout above the resistance level. For a rounding top, the sell signal is the breakdown below the support level formed at the beginning of the pattern. The price target is calculated by measuring the depth of the rounding pattern, from the high or low to the breakout or breakdown level, and projecting that distance from the point of the break. Now let's circle back to the triangle family and discuss the symmetrical triangle. Unlike the ascending and descending triangles, which have a clear bullish or bearish bias, the symmetrical triangle is what's known as a bilateral pattern. This means that once the pattern is complete, the price could break out in either direction, up or down. It represents a period of pure consolidation and indecision, where the market is coiling up like a spring before making a significant move. The structure of a symmetrical triangle is formed by two converging trend lines. The upper trend line is descending, connecting a series of lower highs. The lower trend line is ascending, connecting a series of higher lows. The fact that both buyers and sellers are becoming less aggressive as the range tightens is what creates this symmetrical shape. The price is getting squeezed into a smaller and smaller area, and eventually, it has to break out one way or the other. This tightening of the trading range often leads to a very explosive move. Because this pattern is bilateral, you can't just assume it will continue the prior trend, although it often does. It's considered a continuation pattern about 2/3 of the time, but you have to be prepared for a reversal. The key is to not have a bias. Don't try to predict which way it will break. Instead, you need to wait patiently for the market to show its hand. Let the price action tell you what it wants to do. This is a pattern where patience truly pays off. The trading strategy is to be ready for a move in either direction. You would place an order to buy if the price breaks decisively above the upper descending trend line. And you would place an order to sell, or short, if the price breaks decisively below the lower ascending trend line. Some traders even place entry orders on both sides of the triangle, a buy stop above and a sell stop below, and then cancel the other order once one is triggered. This is a way to ensure you catch the move, no matter which way it goes. For the profit target, the method is the same as with the other triangles. You measure the height of the triangle at its widest part, the base, at the beginning of the pattern. Then, you project that distance from the point of the breakout. So if it breaks to the upside, you add that height to the breakout price. If it breaks to the downside, you subtract that height from the breakdown price. This gives you a logical target for what is often a very fast and powerful move. Finally, let's cover the wedge pattern. Wedges are similar to triangles in that they are formed by two converging trend lines. However, the key difference is that in a wedge, both trend lines are slanting in the same direction. Either both are slanting up, or both are slanting down. These are typically considered reversal patterns, signaling that the current trend is losing its momentum and is likely to reverse course. Let's start with the rising wedge. A rising wedge is a bearish reversal pattern. It can form either at the end of an uptrend or during a downtrend as part of a temporary rally. It's characterized by two converging trend lines that are both slanted upwards. The price makes higher highs and higher lows, but the slope of the support line is steeper than the slope of the resistance line. This means the price range is narrowing as it moves up. This is a critical signal. It shows that even though the price is still rising, the momentum behind the move is fading. The upward thrusts are becoming weaker and weaker. The bearish signal is triggered when the price breaks down and closes below the lower, steeper support trend line. This breakdown confirms that the weakening upward momentum has finally given way and the sellers have taken over. It's a very strong indication that a significant move to the downside is about to begin. The pattern is especially powerful when it forms after a long uptrend, as it signals exhaustion. It can also be a trap for buyers who see the price making higher highs and think the trend is still strong. The opposite pattern is the falling wedge, which is a bullish reversal pattern. It can form at the end of a downtrend or during an uptrend as a form of consolidation. It's defined by two converging trend lines that are both slanted downwards. The price is making lower lows and lower highs, but the slope of the upper resistance line is steeper than the slope of the lower support line. This shows that the sellers are losing their power. The downward moves are becoming less aggressive, and the selling pressure is diminishing. The bullish signal is confirmed when the price breaks out and closes above the upper, steeper resistance trend line. This breakout indicates that the buyers have absorbed the selling pressure and are now ready to push the price higher, starting a new uptrend or resuming the prior one. For both wedge patterns, the profit target can be calculated by projecting the height of the wedge at its widest point from the breakout or breakdown point. However, many traders also target the beginning of the wedge formation as a more conservative initial target. Alright, theory is great, but let's see how these patterns actually look on a real chart. Talk is cheap, right? Let's pull up a chart of Tesla from late 2020. You can see this massive run-up the flagpole followed by this beautiful, tight consolidation. See how the trend lines are converging? That's a classic bull pennant. And look what happened right after the price broke out above the upper trend line, an absolutely explosive move higher. The target, measured from the flagpole, was hit perfectly. This is a textbook example of a continuation pattern in action. Now let's look at a different kind of example. Here's a chart of Bitcoin from its 2021 peak. Look at this structure. We have a peak here, the left shoulder, then a pullback, followed by a rally to a much higher peak, the head, and then another pullback followed by a lower peak, the right shoulder. You can clearly draw the neckline connecting the lows. When Bitcoin broke that neckline, it was the start of a major bear market. This head and shoulders top was the warning signal that the party was over. Let's find a double bottom. Here's a chart of Apple from 2023. The stock was in a downtrend. It hit this low, bounced, came back down and tested that exact same low again, and held. It formed a perfect W shape. The confirmation came when the price broke above the peak of that middle rally. That breakout was the signal to go long, and it marked the beginning of a new powerful uptrend for the stock. Seeing this pattern play out in real time on a major company like Apple shows you just how effective it is. Here's an example of a rising wedge on the S&P 500 index. You can see the index was grinding higher, making higher highs and higher lows. But notice how the lines are converging. The upward momentum was clearly fading. This was a warning sign. And sure enough, once the index broke below that lower support trend line, we got a sharp, fast correction to the downside. This is a classic reversal playing out on the scale of the entire market. It shows that the psychology these patterns represent applies to individual stocks and broad market indexes alike. Finally, let's look at a rectangle pattern on a chart of Amazon. For several months, the stock was just stuck in a box. It would rally up to around $145, get rejected, fall back to around $125, find support, and then repeat the cycle. It was in a clear trading range. Traders could have played the range, buying at support and selling at resistance, but the big money was made by waiting for the breakout. When it finally broke above that $145 resistance, it started the next major leg up. This shows the power of being patient and waiting for confirmation. So there you have it, a complete breakdown of the most essential chart patterns you need to know as a trader. We've gone from simple continuation patterns like flags and pennants to the major reversal signals like the head and shoulders and double bottoms. As you can see, these patterns are not just random squiggles on a screen, they are the footprints of the market, telling a story about the ongoing battle between buyers and sellers. Understanding this language gives you a massive advantage. It allows you to identify high-probability entry points, set logical profit targets, and manage your risk more effectively. It transforms you from a gambler into a strategist. But here's the most important part. Watching this video is just the first step. Knowledge is useless without application. The real learning begins when you start opening up charts and trying to identify these patterns for yourself. Go through historical charts of your favorite stocks and see how many of these patterns you can find. See how they played out. This practice will train your eyes to spot these setups in real time as they are forming. Don't just take my word for it, prove it to yourself. The more charts you analyze, the more intuitive this will become. It's like learning any new skill. Repetition is the key to mastery. Remember, no single pattern is a magic bullet that works 100% of the time. The best traders use these patterns as one tool in a larger toolbox. Combine chart pattern analysis with other indicators like volume, moving averages, or RSI to build a more robust and comprehensive trading strategy. Use them to put the odds in your favor, but always practice proper risk management. Thank you so much for watching. I really hope you got a ton of value out of this. If you did, do me a favor and absolutely destroy that like button, subscribe for more content just like this, and let me know in the comments which pattern you're most excited to start using. Until next time.